February 2025, the President of the United States steps onto Air Force One and says 6 words that shake the financial world. We're going to make sure the gold is there. 52 years, no independent audit, no verification, no proof. 147 million ounces of gold. Or an empty vault behind a locked door. What happens if America's greatest financial secret is exposed? Silver doesn't go to $120. It doesn't stop at $150. It goes somewhere no one is prepared for. Welcome to John Analyst. If you've made it this far, you already know something most people refuse to see. Before we go deeper into this story, a small request. If you're a seasoned investor, a business professional, someone who's watched markets rise and fall over the decades, you understand the value of staying informed. That subscribe button below, it costs you nothing, but it ensures you never miss a critical warning like this one. Go ahead, take a moment, subscribe now, and while you're at it, drop a comment. Tell us, where are you watching from today? New York, London, Dubai, Karachi, Sydney? Let us know, because what we're about to reveal affects every corner of the globe. Now, let's begin. On February 20th, 2025, something extraordinary happened. The President of the United States, Donald J. Trump, stood aboard Air Force One, surrounded by reporters, cameras rolling, and made a statement that no sitting president has ever made in modern history. He said, and these are his exact words, "We're going to go into Fort Knox to make sure the gold is there. If the gold isn't there, we're going to be very upset." Let that sink in for a moment. The leader of the most powerful economy on earth, the commander of the world's reserve currency, just admitted, publicly, on camera, that he does not know if America's gold reserves actually exist. This was not a press release. This was not a prepared statement vetted by Treasury officials. This was the president, speaking freely, raising a question that has haunted financial analysts for decades. Where is the gold? Is it really there? And why, after 52 years, has no one been allowed to verify it? The very next day, February 21st, 2025, Senator Rand Paul took action. He sent a formal letter to Treasury Secretary Scott Bessant, demanding an in-person inspection of the United States Bullion Depository at Fort Knox. His deadline, March 19th, 2025. In that letter, Senator Paul wrote something remarkable. He stated that 42 years had passed since any civilian was permitted to enter and view the gold vault, but the reality is even more alarming. The last full public audit of Fort Knox, the last time independent observers were allowed inside, was September 23rd, 1974. That is 52 years ago, as of January 2026. To understand why this matters, one must first understand what Fort Knox represents. The United States Bullion Depository was constructed in 1936, during the Great Depression, at a time when America needed to restore confidence in its currency. By 1941, Fort Knox held 749 million ounces of gold. That is 20,216 metric tons, the largest gold reserve ever assembled in human history. This gold was the backbone of the US dollar. It was the collateral, the guarantee, the foundation of trust. When foreign nations held dollars, they believed those dollars were backed by real gold, sitting in Kentucky. But here is what most people do not know. Fort Knox has not held that much gold for over 80 years. According to the United States Mint, as of January 2026, Fort Knox officially holds 147.3 million ounces. That is approximately 4,580 metric tons, a reduction of 80% from its peak. Where did 600 million ounces of gold go? The Treasury Department offers an explanation. They claim the gold was sold, leased, or transferred to other Federal Reserve banks, to foreign institutions, to manage the dollar's stability. But here's the problem. No one outside the Treasury has verified those claims since 1974. For 52 years, Americans have been asked to trust that the gold is there. The possibility that gold has been secretly sold over decades to fund classified programs, to settle hidden debts, to bail out foreign governments without congressional approval, without public knowledge, without any record. If this explanation is true, if Fort Knox holds significantly less gold than officially reported, then the United States government has been lying to the world for 50 years. And when that lie is exposed, every foreign central bank holding US dollars, every sovereign wealth fund invested in American assets, every institution that trusted the full faith and credit of the United States will run for the exit. The dollar will not decline, it will collapse. This is why the audit matters. This is why Trump's demand is not political theater. This is why Elon Musk is asking questions publicly. They sense what analysts have suspected for years. Something is wrong. Something does not add up. And the 52-year silence is not protecting national security. It is protecting a secret that, when revealed, will send shockwaves through every market on Earth. There's a question that haunts every serious financial analyst, a question that has no satisfying answer, a question that the United States Treasury refuses to address directly. Why? Why has there been no independent audit of Fort Knox for 52 years? If the gold is there, if every ounce is accounted for, if the vaults are full and the records are clean, then why not open the doors? Why not invite cameras, independent auditors, congressional oversight? Why not silence the skeptics once and for all? The answer lies in understanding how governments protect secrets. They do not deny. They do not confirm. They simply delay. They deflect. They hope the question goes away. Treasury Secretary Scott Bessant, appointed by President Trump in 2025, has addressed the audit question multiple times. His response is always the same. We conduct an audit every year. All the gold is present and accounted for. On the surface, this sounds reassuring, but beneath that reassurance lies a critical distinction. Bessant is referring to internal audits, audits conducted by Treasury employees, audits where the results remain classified, audits where no independent third party, no outside observer, no congressional investigator ever verifies the findings. Consider this analogy. A bank manages billions of dollars in customer deposits. One day, customers ask for proof that their money is safe. The bank responds, "We audit ourselves every year. Trust us." No independent accountant, no regulatory inspection, no transparency. Would any rational investor, any seasoned businessman accept that answer? The answer is obvious. Yet, this is exactly what the United States Treasury has told the American public for 5 decades. So what are they hiding? Analysts who have studied this question for years have identified 3 possible explanations. Each one carries profound implications. Each one reveals why the Treasury may be terrified of a genuine audit. Explanation 1, the ownership problem. Not all gold in Fort Knox belongs to the United States government. A significant portion is held in custody. Custody for foreign central banks, custody for international organizations, custody for private institutional clients. The Treasury has never disclosed exactly how much gold is American property and how much is simply stored on behalf of others. If an independent audit revealed that only 60 or 70% of Fort Knox gold actually belongs to the United States, the implications would be devastating. The dollar's credibility, built on the assumption of vast American gold reserves, would collapse overnight. Foreign nations holding dollars would demand answers, and the Treasury would have none to give. Explanation 2, the encumbrance problem. Gold leasing is a practice that few people understand, but it has been used by central banks for decades. Here's how it works. A central bank, such as the Federal Reserve, lends gold to a commercial bank. The commercial bank sells that gold on the open market, creating supply, suppressing prices, generating profit. On paper, the central bank still owns the gold, but physically, the gold is gone. It sits on a balance sheet as an asset, as a claim, but the vault is empty. If an audit revealed that 40 or 50% of Fort Knox gold has been leased out, sold into the market, and no longer physically exists in Kentucky, the scandal would be unprecedented because leased gold can be recalled, but recalling gold takes time. And in a financial crisis, there is no time. The world would discover that America's gold reserves are not reserves at all. They are IOUs, promises written on paper. And paper burns. Explanation 3, the depletion problem. This is the scenario that no Treasury official will ever admit. The possibility that gold has been secretly sold over decades to fund classified programs, to settle hidden debts, to bail out foreign governments, without congressional approval, without public knowledge, without any record. If this explanation is true, if Fort Knox holds significantly less gold than officially reported, then the United States government has been lying to the world for 50 years. And when that lie is exposed, every foreign central bank holding US dollars, every sovereign wealth fund invested in American assets, every institution that trusted the full faith and credit of the United States will run for the exit. The dollar will not decline, it will collapse. This is why the audit matters. This is why Trump's demand is not political theater. This is why Elon Musk is asking questions publicly. They sense what analysts have suspected for years. Something is wrong. Something does not add up. And the 52-year silence is not protecting national security. It is protecting a secret that, when revealed, will send shockwaves through every market on Earth. There's a metal. that powers every smartphone on Earth, every solar panel, every electric vehicle, every medical device, every satellite orbiting the planet. A metal so essential, so irreplaceable, so deeply embedded in modern civilization that without it, the 21st century economy would collapse within months. That metal is silver. And yet, almost no one is paying attention to what is about to happen. When trust in government gold reserves collapses, when the Fort Knox audit reveals what analysts have long suspected, capital will flee. Trillions of dollars. Searching for safety, searching for something real, something that cannot be printed, something that cannot be faked, something that cannot be hidden behind classified reports and locked vault doors. The obvious choice would be gold. But here's the problem. Gold is a government asset. Central banks hold gold. Sovereign wealth funds hold gold. The very institutions whose credibility will be destroyed by the Fort Knox scandal are the same institutions that control the world's gold supply. If investors lose faith in government gold reserves, they will lose faith in all government-held gold. Fort Knox, the Federal Reserve, the Bank of England, the IMF. Every major gold vault will face scrutiny. Every official number will be questioned. Gold becomes tainted by association. But silver? Silver is different. And understanding this difference is the key to understanding what comes next. In 2002, the United States government made a decision that received almost no media coverage, a decision that would prove catastrophic 2 decades later. The U.S. Treasury sold its last remaining strategic silver reserve, 165 million ounces, liquidated, used to mint American silver eagle coins, and just like that, the United States government held 0 ounces of silver. Let that satisfying sink in. The most powerful economy on Earth, the nation that consumes more silver per capita than almost any other, has no strategic silver reserve. None. Not a single ounce. This means when the Fort Knox scandal breaks, when investors panic, when capital flees government-controlled assets, there's no government silver to flee into, no treasury vault to trust, no Federal Reserve stockpile to question. The only silver that exists is private silver. Silver held by miners, silver held by refiners, silver held by individuals. And there's not nearly enough for what is coming. The mathematics of silver are terrifying. In 2025, global silver mine production reached approximately 850 million ounces. That sounds like a large number. It is not. Because in that same year, global silver demand exceeded 1.2 billion ounces. Industrial demand alone consumed 750 million ounces. Solar panels required 130 million ounces, just for Chinese installations. Electric vehicles required another 80 million ounces globally. Electronics, medical devices, water purification, military applications. The list is endless. And then there is investment demand. In 2025, investors purchased 300 million ounces of silver, coins, bars, ETFs, people seeking protection from inflation, from currency debasement, from the collapse of trust. Add it together, 850 million ounces of supply, 1.2 billion ounces of demand. The deficit is 350 million ounces. Every single year, where does that deficit come from? It comes from above-ground inventories, stockpiles accumulated over decades, reserves held in vaults, in warehouses, and depositories around the world. But those inventories are disappearing. The COMEX, the primary precious metals exchange in North America, held over 130 million ounces of registered silver in 2020. Registered silver, meaning silver available for immediate delivery, silver that backs the futures contracts traded every day. As of January 2026, that number has collapsed to 40 million ounces, a 70% decline in just 6 years. In London, the LBMA vaults have seen similar drawdowns. Inventory is down 40% since 2020. In Shanghai, available silver reserves cover barely 30 to 45 days of current demand. The world is consuming silver faster than it can be mined, faster than it can be recycled, faster than any new supply can come online. And here is the critical point. Silver supply is inelastic. It does not respond quickly to price increases. 70% of silver production comes as a byproduct of copper, lead, and zinc mining. Miners do not mine silver directly, they mine other metals, and silver comes along for the ride. Even if silver prices doubled tomorrow, even if silver reached $200 per ounce, new mines would take 5 to 7 years to develop. Permits, environmental reviews, infrastructure, capital investment, the supply cannot catch up. Not in time. This is the trap. This is the equation that almost no one understands. A 350 million ounce annual deficit, collapsing inventories, inelastic supply, and now a looming crisis of confidence in government precious metals reserves. When the Fort Knox audit results are announced, when trust evaporates, silver will not rise gradually, it will not climb politely, it will explode. In the world of financial markets, prices do not move randomly. They respond to forces, pressures that build quietly, invisibly, until one day the dam breaks. And when it breaks, those who understood the pressure profit. Those who ignored it are swept away. Silver at $159 per ounce is not the peak, it is the beginning, the foundation of a move that analysts have mapped with increasing precision. 6 catalysts, 6 forces, all converging toward a single destination, $200 per ounce, and possibly far beyond. Catalyst 1, industrial demand acceleration. The global economy runs on silver, not metaphorically, literally. Every solar panel requires approximately 20 grams of silver. Every electric vehicle requires between 30 and 60 grams. In 2025, China alone installed 216 gigawatts of solar capacity. That single nation consumed 130 million ounces of silver just for solar panels in 1 year. India is accelerating its renewable energy infrastructure. The European Union is racing to reduce dependence on Russian energy. The United States is investing billions in domestic solar manufacturing. This demand is not speculative. It is structural, it is permanent, and it is growing at 15 to 20% annually. Catalyst 2, investment demand surge. Something shifted in late 2025. Google Trends recorded an all-time high in searches for how to buy silver. Coin dealers across North America reported inventory shortages. Premiums over spot prices widened to $20, $30, $40 per ounce. This is not institutional buying. This is retail awakening. Millions of individuals recognizing what is coming, converting paper currency into physical metal. When this wave accelerates, when fear becomes panic, there will not be enough silver to satisfy demand at any price. Catalyst 3, the Fort Knox audit results. The audit requested by Senator Rand Paul. It carries 2 possible outcomes. Outcome 1, the gold is verified, markets breathe relief. Silver may consolidate briefly. But the structural deficit remains. The price continues upward. Outcome 2, discrepancies are revealed. Missing gold, accounting irregularities, evidence of leasing or secret sales. In this scenario, panic is immediate. Gold spikes. Silver spikes harder. The flight from government-backed assets accelerates beyond control. $150 becomes $180 in days. Catalyst 4, the gold to silver ratio collapse. Throughout history, the gold to silver ratio has served as a barometer of market sentiment. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. In January 2026, the ratio stood at 50. Historically, when this ratio falls below 40, silver enters a period of extreme outperformance. When it approaches 30, silver is in a generational bull market. At extreme moments, the ratio has touched 20. If gold reaches $4,000 per ounce and the ratio compresses to 30, silver reaches $133. If the ratio overshoots 20, silver reaches $200. The mathematics are inescapable. Catalyst 5, China's export restrictions. On January 1st, 2026, China implemented export controls on silver. The metal was classified as a strategic dual-use material. Only 44 companies received licenses to export silver from China. As geopolitical tensions escalate, as trade wars intensify, China may tighten these restrictions further. Quotas may be reduced, licenses may be revoked. Western markets, dependent on Chinese supply, will face shortages that no amount of money can solve. Physical silver in Europe and America will trade at $50, $70, $100 premiums above paper prices. Catalyst 6, COMEX force majeure risk. This is the scenario that terrifies institutional traders. The COMEX operates on a fractional reserve system. For every ounce of physical silver in registered inventory, multiple paper contracts claim ownership. As long as most contract holders accept cash settlement, the system functions, but if physical demand overwhelms available supply. If too many buyers demand actual metal, when the exchange faces a choice, deliver metal it does not have, or declare force majeure and settle all contracts in cash. This has nearly happened before. March 2020. During the pandemic panic, COMEX came dangerously close. If it happens in 2026, the paper silver market loses all credibility. Physical silver decouples entirely from paper prices. Physical trades at $200, while COMEX quotes $120. The illusion is shattered. The historical warning. There is a precedent for what governments do when they are desperate. April 5th, 1933. President Franklin Roosevelt signed Executive Order 6102. American citizens were ordered to surrender their gold. Failure to comply carried a penalty of 10 years imprisonment. The government confiscated gold at $20.67 per ounce. 9 months later, They revalued it to $35, a 70% profit, stolen from the American people. Today, the government holds no silver, but if crisis strikes, if confidence collapses, what stops them from declaring silver a strategic national security asset? What stops them from invoking emergency powers? The precedent exists. The legal framework exists. The motivation is building. This is why physical possession matters. This is why paper promises fail in crisis. This is why the next 12 months will separate those who prepared from those who did not. $200 silver is not a fantasy. It is not clickbait. It is a mathematical inevitability, written in supply deficits, in collapsing inventories, in 6 converging catalysts, and in the 52-year silence that is finally breaking. The audit is coming. The truth is coming, and those who understand will not be caught unprepared.